A listener asked us to explain options contracts, those financial Swiss Army knives that variously can be used to add income to an existing portfolio, protect against price drops, or take a shot at profiting from a big price move, whether up or down. These contracts are called options for a reason. They give the buyer the option, but not the obligation, to buy or sell something at a preset price within a preset period of time. That something might be a stock, a bond, an ETF, or other publicly traded financial instrument. Used correctly, they can reduce risk, for a price, of course. But used recklessly, they can be instruments of financial self-destruction. Sound complicated? Sound scary? Maybe, but listen on as we try our hand at giving you a kindergarten-level explanation of what these tools are, how they work, what the opportunities are, what the risks are, and what your next steps might be in learning more. All that and more right now on the Retirement Lifestyle Show.
Welcome to the Retirement Lifestyle Show. I'm your co-host, Erik Olson, along with Roshan Loungani and Adrian Nicholson, and we're back for another episode. Guys, how you doing this morning?
Great, Erik. I'm happy to be here. Roshan, it's good to see you too. How are you doing today?
Great. I'm looking forward to this episode, and our topic for today will be covering options. So I'm looking forward to going over that. Also, I'm starting to see things get. This was the first week I've been in the office, 2 back-to-back days since last March or April. So I'm also excited about seeing things getting back to normal.
Yeah, I'm really excited too. It felt nice too. I was in the office yesterday. It felt nice just kind of waking up, doing my old routine in the morning, getting dressed up, and just headed to the office. It was kind of just a nice change of pace. It was definitely kind of helped me look a little bit more to the future, kind of that old routine I used to have. That felt nice.
So basically, your sweats are all worn out, your slippers are all worn out. It was time to
Erik, the funny thing is too, before the pandemic, I was gonna do like a big update on my wardrobe, get like new work clothes and everything, but I just kept pushing it off, and then I was working from home a lot more, so that kind of got pushed way along down the line.
Yeah.
Oh boy, howdy. I understand that so much. I spent so much on new suits in October of 2019, and now suits are totally passé. No one's going into.
Do you have any recommendations, Erik, on any suits that I could maybe look into?
Well, yes, I do. I would say that I'm a little bit of a fan of Joseph Abboud. So because I just like the fit and the look and the cloth and that sort of thing. But there's plenty of other options.
What about you, Roshan? What would be your go-to?
Well, luckily I've got the connection there because my dad's business was making custom-made suits.
No kidding! Wow.
I don't think I've ever bought a suit. I've gotten them for birthdays or holidays. Anytime I need a suit, that would be the gift.
Well, so what you're saying is the next time I'm in DC, I need to come use my in with your dad and see if I can finagle a custom suit.
Yes. Next time you're in DC and we go to that beer garden, I'll tell him to join us.
All right, that sounds great. Well, so guys, on the subject of options, this is a topic that we have not addressed before, and so it is. We've talked about other asset classes and other parts that our clients could consider incorporating into their portfolio, but never options. And so it's time. But why is this an important thing for our listeners to understand more about?
Yeah, Erik, and I can lead us into it. I'll kind of give like a brief definition on options real quick, and I'll lead into why this is kind of an important area and why we're covering it. Just a basic definition, Roshan can probably go a little bit more detailed into this, is an option is a contract that can give an owner the right, but they're not obligated to buy or sell an underlying asset at a specific price, and it does have a specific date to the option. And option contracts normally represent around 100 shares of an underlying security, And some factors that play into options are their daily trading volume, which we'll probably go into, and their open interest that can really make or break and when it comes to making certain decision factors. And options can play a role in your financial picture or your portfolio, where they do provide hedging opportunities, income, and they are a way to have some speculative strategies implemented into your approach. What do you think, Roshan?
Yeah, if we ever needed the disclosure or disclaimer we used last time of kids don't try this at home, I cannot think of a better place than when we're talking about options, because options incorporate leverage. Leverage means you're borrowing to finance this trade or this investment you're doing. And anytime you have leverage, yes, you can make a lot, but you can lose money really fast. So I think this is definitely a good topic for us to cover. I want to thank one of our loyal listeners, Neil, who mentioned that he thought this would be a good topic. Loyal listener and friend. And so he had said, I think it'd be great for you to cover this. And as we're going into why this is important, we'll go into the details of the contract. But this year, with the madness with GameStop and then the meme stocks and so on, retail investors, which are individual investors that are going in sometimes with a broker and sometimes it's just using any kind of account like their Robinhood account, they've been overwhelmingly buying more and more options. So you can use that as a way to be an aggressive trader to try to make money, but you can very, very quickly lose money. So I would caution anyone to use options wisely. And there's as I've said many times on here, I'm a huge Warren Buffett fan, and he has a quote that says, "I've seen more people fail because of liquor and leverage," is his quote, and options involve leverage. So I would just say, be careful. We do not want you to fail as an investor. And on our previous episodes, we've had the couple that come to mind. One is investing, trading, and speculation. Options can and are used by many for speculation, and speculating is just a way you can lose money quickly. So be careful with that. Okay. And one last point, where this is going to be like a 101 or below, like a kindergarten episode, similar to the way we covered Bitcoin.
All right, so on the basis of what the two of you have said so far, here's my initial takeaway. I think I'm trying to put myself in the sort of ears of the listener. I'm hearing complicated and scary, and I'm ready to turn off the podcast because I'm thinking, why is it important for me to know something that's something that's complicated and scary? Help me out. Why is it useful for a listener to understand options, and what positive role, despite their complexity and the potential risks that are involved in them, why is it useful to understand more about this, and even more importantly, whether or not the listener comes to a deep understanding, at least if they come to a point of appreciation and I think this might play a role, what important role can options play in their portfolio?
When used correctly, you can hedge the portfolio, which means you can lower your risk and be protective of your portfolio. You can also use it to protect capital in situations where you want to invest in something that may be speculative, but you believe in the idea. You can invest less money and get the same amount of exposure through options. And also, I think the most important part is, it's scary and complicated. Yes, if you plan to use it, though, you would want to know what's so scary and why it's so complicated, right? So you can use that information to either say, this is not right for me at all, or you can use that information to say, well, maybe this is something I should look into further because I can manage my money more effectively with it.
Yeah, that's a great point, Roshan. Like you said, a lot of retail investors are getting involved with options. I'm starting to see a lot of, like, on social media too, people are writing options or buying call or put options, and they're literally taking screenshots and posting it. Like, I can't go a day without going on social media without seeing someone I know doing this. So it has been a lot more popular compared to a couple of years back, where people are doing this. And the most important thing that we want to our listeners to know is just to educate them on this. How can this be a part of your financial pictures? What are the risk aspects that you should consider? And just learning the most you can about it, I think, is a good starting place. And I do like how you talk about it's a hedging opportunity where you can reduce some risk exposure in your portfolio. And there's also an income aspect of it as well, where you can, if you're an option writer, which we'll probably go into more, you can generate some additional income. I think is really interesting. But like you said, this is it can be very complex, but just knowing more about it is an extremely important point to begin with.
All right, so I want to get us started down a certain path here, because I'm tempted on the one hand to ask, for which investors is this useful and potentially appropriate, and for which investors would this be less useful and perhaps less appropriate? But I think that might even be the wrong question.
Well, actually, Eric, I would say that I would agree with you that that's not the right question, just because I would view this as an academic conversation at this point. If you listen to this podcast, at the end of it, especially if you're managing money on your own, or you're working with someone to manage your money, at the end of this podcast, it should lead to additional research or conversation, not to going out and saying options are right for me or wrong for me to use in the portfolio. Wrong for you is okay, though, I'd say. If you decide that this isn't right for you, I don't have a problem with that. If you decide this is right for you, I don't think we're going to cover enough to make that decision. We're just telling, at the end of this, if you think it may be right for you, additional research and conversation is probably the next step.
All right, so I want to start us down a certain path, which, instead of taking it as there's a global answer to the question, for which investor is this useful and for which investor is this not useful, let's instead take the topic, or break it down into some subsets. And these subsets would be applications of option strategies.
Before we even go there, I think we should explain what they are. Right? We've talked about them. So, and Adrian gave us a little bit of a background that an option is a contract that gives you or the person on the other side of the trade the option to do something. So let me explain what that means. And I'm not recommending any securities to you or anything like that, but I'm just using the S&P 500 as an example as we go through this, just because, or the SPY, the spiders, which is the ETF for the S&P 500, just to give us data. But when you first start out with an option has a few key points. First is an option expires. Right, and that's a very important thing to note, is that an option expires. So if you were to go out and buy a stock that you think is a good investment for the long term, and you buy it, well, you can theoretically wait forever till it appreciates to the point that you have. Whereas with an option, there is an end date, so they have an expiration. The other important point on the option contract is they have a strike price. The strike price is the price at which you are either profitable or losing money in the option, compared to the spot price, which is the current price. So I'm going to give you specifics on this just to let it sink in. And as I said earlier, not recommending anything. This is an academic exercise, but we're going to use the S&P, the spiders, the SPY, which is the ETF for the S&P 500. And the markets are open as we are discussing this, so the price changes. But right now, the spot price it's trading at $391 per share right now. If you were to get an option where you wanted it to go, where you thought it would appreciate, that expires today, which literally means it has to go up above $391 today for you to profit. That would be if your strike price was also $391, which is the current price. So, one is, when does it expire? Two is, what is the strike price, meaning at what point is that option in the money for you? At 3 is what is the spot price today, and then 4 is the premium. What do you pay for that? So going back to my example, and as I said, the markets are open, so everything is moving, but I want to give you this number to illustrate the level of leverage. So right now, the S&P 500 SPY, the ETF, is trading at about $391. That's the spot price. If you bought a call option, meaning you think it's going to go up, and you bought that option expiring today, so it expires today, which means if it doesn't go up beyond your price today, it's worthless. It goes to zero, and you've lost everything you've put into it. And you're buying it at a strike price of $391, meaning if it's at $391 right now, and it's got to go up from here. You only need to pay 85 cents a share for that. So when we talk about leverage, think about this for a second. This costs $391. So if you wanted to buy one share, you've got to pay $391. But if you want to place a bet that it's going to go up today, you only have to pay 85 cents. That's the leverage, right? You're putting in 85 cents to get exposure to $391. And that's the profit side, right? If it goes up to $5 today, you put in 85 cents, and your 85 cents went up a little under fivefold. But that's also the risk. You put in 85 cents, and if you're wrong today, what you put in literally goes to zero. So whereas if you just thought it would go up, you could buy the share for $391 and wait. I'm sorry, one last point, Adrian, then I'm going to go to your question. Option contracts trade at 100 shares at a time. So you can't just buy one share exposure on a contract. Even though I quoted it as 85 cents, that is accurate on a per share basis. If you were to actually buy it, you'd have to spend $85. But once again, you're spending $85 in this case to get exposure to $39,100 of an investment. So that level of risk, leverage is so huge. That's where the risk is. Adrian, I'm sorry to have cut you off. What was your question, though?
No, perfect. I just want to kind of just add on something so our listeners can follow along with your example here. And I want to touch on the risk aspect again, so to really drive that home. So the risk in this example, Roshan, to the call option buyer is that 85, the premium they paid. Is that correct? Or how would you touch on that?
If you are, and there's another wrinkle there, Adrian. Yes, you're right from what I described. If you were buying this, you're risking 85 cents a share, but because you have to buy 100 shares, you're risking $85 if you bought it. That means that it's got to go up for you to make money. But the other side of it that further complicates options is you can be a buyer or a seller.
Yeah, right? Exactly, Roshan. And the option seller, they're the ones that are pocketing this premium that is paid, correct?
Yeah, so let's use this example. And Adrian, you are the seller and I'm the buyer, right?
Perfect, yep.
So I come to you and I say, Adrian, I'm betting it's going to go up from $391. And you're saying, all right, Roshan, give me $85. I give you $85 right now.
Okay, yep.
So now, if it's above $391, if it's at $391 and 10 cents, well, I'm going to get $10. I'm going to close the contract and get $10 back, but I lost $75. I was right in that it went up, but it needs to go up beyond the 85 cents I paid.
Yeah.
So if it goes to let's just say it goes up to 382, right? And I'm
392.
Thank you, Eric. That's exactly what I was going to say. Let's say it goes up to 392. Well, if it goes up to 392, well, my strike price is 391, so that's $1 a share. But then I paid 85 cents per share to you, Adrian, for the contract. So I've made 15 cents per share because there are 100 shares. It went up a whole $1, but I only made $15. I put in 85, and in theory, I got back 100. So I made $15. Now, let's talk about the risk on the other side. Let's just say it goes down.
I want to mention that real quick. Since I'm the option seller in this case, Roshan, would my risk be infinitely greater because you're the call buyer in this situation, and since I'm the seller in this situation, the stock price can just keep going up and up. Like, I know a common term is the stock can go to the moon. So would I be taking on greater risk since I'm the seller in this case?
Yes, and I'm going to come to your risk in a second. I just want to wrap up the risk of the buyer first. As a buyer, my risk is capped at that $85.
That
if
premium
it goes
paid.
down, I paid you $85. If it goes down, I lose my $85. That's all I can lose is the $85. Okay, as the seller, have definitely taken on greater risk. I'm going to put numbers to this. So it's at $391. I gave you $85. You got that today. And let's just say I'm going to pick a ridiculous number because I'm a fan of doing that. Let's say today it goes up by $100, right? So it goes up to $491, right? Which this is definitely an extreme answer. Not happening in a day.
I like that.
I'm tempted to jump in. Which day is the S&P 500 going to go up $100?
Well, it just shows you how much Adrian
That's ridiculous. That's so
much. Roshan, I thought I was going to.
Sorry, I'm just having fun with you. Echoes of last
week. I
week.
was going to make you. Yeah, go ahead, Roshan.
You name the number, but on my $100 example, it goes up $100. Adrian would have gotten $85 in premium, but he would have lost $10,000 in total. Yeah, so remember, as a buyer in this case, my risk is capped to what I pay the premium. As a seller, your profit is capped at the premium, but your loss can be infinite.
Yeah, and like I said, it could go to the moon. I thought I was going to make you laugh, Roshan. Have you heard that terminology before when people say, oh, this stock can go to the moon?
I have definitely heard people say that. And on our example, why Erik started flipping out a little bit there is because, the S&P going up $100 a share, or in percentage term going up 25% in a day, that's I hate saying anything's impossible in this market, right? But pretty close to it.
But it's still I'm just having fun with you. But the point is, how does the seller limit their risk? There's a very straightforward way.
Well, I don't want to get too complicated in other strategies. That seller could then be a buyer in another option at a higher price to limit their risk.
All right, so here's what I'm going to. Here's what I was thinking you were going to say is that if Adrian owns SPY to begin with, so it goes up $100 a share, a very good day. Adrian, in one sense, didn't lose $10,000. He lost the opportunity to have sold his shares for $10,000 more.
Yeah. So what Erik is describing is called a covered call. So in this example, Adrian as the seller is not necessarily being a speculator because he owns the shares already. So what he's trying to do is generate income. So using this covered call strategy, Adrian owns 100 shares of the S&P 500. I keep saying the S&P 500, and we're specifically using the spider, which I keep saying we're not recommending it. This is an academic exercise. But Adrian owns 100 shares of this spider. He sold that option to get $85 in income. If it then, in fact, goes up by $100 a share, in this imaginary day, right? It goes up $100 a share. Adrian has not lost $10,000. He's lost the opportunity to earn that $10,000, and in return, he got $85. So
he's, instead of being $10,000 better off than the day before, he's $85 better off than the day before.
Yes, exactly. So with the options, what I wanted to touch on, and as Erik mentioned, the strategy in protecting your loss, there are a number of strategies that can get very complicated that I can't imagine explaining well without a chalkboard or without the visuals. But I want to go back to the very beginning of when we started describing the options and what we were going for with the examples. One is the options have the key information you need is what is, and the terminology used. What is the current price of the stock, which is called the spot price? That is terminology used by the options, but that isn't necessarily one of the three important elements in the contract. The contract includes the expiration date. So when will the contract expire? The contract includes the strike price. That's at what point is the contract in or out of the money. And then the contract involves a premium. And I keep using the word contract because it is called an option contract. It is a contract that you have with the other party, the other side of the transaction. In our example, we said Adrian was on one side and I'm on the other. These are traded through exchanges, so you don't need to know who it is or find a party to make a deal with. You can just go on your computer and click through to buy it.
Yeah, and Roshan, real quickly, before we move on, I'd like to go back to your example because we did focus on the call option example. Can we just use the same example and in this case use a put option? I think our listeners would like to hear a little bit about that as well, where a put option allows the holder in this case to sell at that specific price. Can we do the example again and focus on if you're using a put option in this case?
Yeah, and I'm gonna start with saying you're a buyer and not a seller, and explain something. I once saw an example at a presentation where the person said a call you want, if you're a buyer once again and you're buying a call option, you want it to go up. And when you're buying a put option, you want it to go down. The example he used was, and for the people that are old enough to remember phones that were not cell phones or not wireless, he would say you pick up a call or you put down the receiver when you pick up the phone. So I'm hoping that'll just help make it easier. You pick up a call, you want it to go up, or you put down the phone when you're done with the call, you want it to go down. So Adrian, the example we used was I'm a buyer previously of a call option. I want it to go up. Let's just say now I think it's going to go down, so I buy a put. So I'm buying a put, and I need the stock price to go down. So using the same numbers we did, and the price has gone down a little bit on the SPY since we talked. But right now it's trading a little over $391. If I buy a put saying I need it to go down, it's trading for about $1 a share. So Adrian, I'd have to give you, and because this is 100 shares, I'd give you $100, and I'm betting the stock will go down. So because it's $1, and my strike price in this case is $391. We're trying to do it where the market is now as an example. Well, if it's below $391 at all, I'll get some of my dollar back, so to speak. But for me to actually make money, it's got to drop by greater than $1 for me to profit. So it's got to go down below $390 in this case. Now, going back to my extreme example before, let's just say hypothetically it dropped $100 a share. Well, I paid you $1, so I've made $99 per share, and I have made $9,900 then on my transaction. In this case, however, if it dropped by $100, you initially got my $100, and you lost, in this case, $9,990 a share. And as Erik laughed at me earlier, a $100 move is definitely unlikely. But once again, what this should illustrate is that if you're a buyer, your loss is limited to what you paid. If you're a seller, your loss is unlimited because, as Adrian said earlier, if the stock can go to the moon, or in this example with the put, the stock can go to the ground.
Yeah, the ground be zero. So the put writer in this case, their loss is kind of capped at zero, where on a call option, like we said, it could go to the moon. It can go to any price there. Is that correct, Roshan?
Well, yes, it's zero, but the difference is still huge. Right? Like in this example, we used $100 a share, but I'm gonna let's just say, and this would be a terrible day for the country and all of us, but let's say the SPY went to zero, right? Well, I paid you $100. You got $100 from me, and your loss is capped. but your loss in this case is capped at $39,100.
Okay.
So yes, it's different from writing the call because theoretically, if you write a call, your loss is unlimited. Here, your loss is limited to $39,100, but your gain was still capped at $100. Right.
Okay.
Your risk is still significantly higher as a seller of the option than it is as the buyer of the option.
So there's such an important distinction here it's been interwoven with what you've explained, but the case for either a put, remember putting is you're betting on something going down, or you're trying to protect against something that does go down, versus a call. You're betting that something goes up, or you're trying to make money from something that may not go up, even though someone else thinks it would. The huge difference is whether or not you own the position, the underlying position, or not. And this distinction is known as the difference between naked or covered. So selling a naked call versus selling a covered call. Selling a naked put versus selling a covered put. What, in terms of the application of those, there's completely different scenarios, completely different investment aims of those in each of those circumstances. Do you want to talk about those?
I do and I don't.
Okay.
I say it like that because I'm happy to go over it. However, I think that also can get so complicated. So Eric, for that reason, I'm going to very, very briefly answer the question on the naked put side, but I'll go more in depth, naked versus covered put side, but I'm going to go a lot more in depth with the naked versus and covered call side.
Yeah, and Roshan, once you go over that, can you pass it off to me? Because I think there's also an element to options, too, that I'd like to discuss that I think our listeners would really enjoy.
Yeah, okay. Let me answer that question. So, Eric, as you said, there's a difference between covered and being naked in options and in life, right? So,
that's right.
if going back to the example, if you own shares in the SPY, you own 100 shares, which means you've got about $39,100 invested in that position. If you write the option at $391, that was trading at about $85, so you just got $85 in income. And if it shoots up, your loss is capped because you own the stock. Right? If it goes up $100, you got the $85, you missed the opportunity to make more money, but you didn't lose money, right? You lost the opportunity because you had a covered position. Naked is when I describe the numbers of where you could lose $10,000. If you're doing it covered, it's a strategy to generate income, but if you're doing it naked, it's a speculative move. You're trying to bet it goes one way or the other, and your loss as a writer of that option is completely unprotected. You're flying without a net. You could lose, and as Adrian said, to the moon. You have an unlimited loss. I'll touch on the put part briefly. I just want to go over it briefly because it can be more confusing. If you are the writer of a put, which means the stock is your loss is unlimited if the stock goes down.
Let's clarify. Writer meaning the
seller
of a
You've
put.
sold the put. For your protection to be covered in this case and not naked, it means you have shorted the stock already. So you have sold stock you don't own. You've borrowed stock to sell. You're typically paying interest on that, by the way. And in addition to having borrowed stock to sell, you've then sold an option where if it doesn't go down beyond a certain level, you collect the income. But if it does, your gain is capped. So, and both of these are used in different ways, right? So that's why I gave you the answer of, well, I'll answer it, but I don't really want to, just because I think this is where our average listener puts down the podcast using the terms we have.
Well, here's what I would just like to say is let's go on the call side for just a second. This is the question is, will this stock rise? If I am a buyer of a call, I think it probably will, and I want to take a shot at it, and I'm willing to spend a little money to see it go up, so I can buy it at a lower price than it will be eventually. If, let's say, it has a 1 month expiration, and I think in the next month it might go up $10, I might say I'll buy it at the same. I'll buy it with a strike price equal to the spot price. Pay the $85 for the opportunity within the next coming month to buy 100 shares, and if it's gone to 401 within that month, then I can buy at $391, and immediately what I own is valued at $491. But the seller.
Hold on. Before you move on from this, Eric, you've got to make one point here. This is definitely what you're saying, though, is correct. I think you've got to make the distinction that you're a speculator, not an investor here.
I agree with that.
You've got to make the point. This is not the same as buying the stock. That's the only part I wanted to make clear, because when you buy the stock, there's no deadline, right? If you believe it'll go up, you can wait your whole life for it to go up and own that stock. With the option, that is simply not the case. You have a deadline in this case. So Eric, I'm going to let you continue. I just didn't want a listener to think, well, hey, instead of buying the stock, I can buy the option and just put in less money. Though you're putting in less money, you also have created a deadline, and you better be right by that time frame. You don't have the luxury of waiting.
Yeah, so, I mean, the application of, and Adrian, I haven't forgotten that you have something that you want to add here, but just in terms of wrapping this section up, someone who says, I own SPY, and I'm okay with how it's rising, and I'm okay with the fact that it's paying, what is it? I think it's a 1.9% yield on the dividend right now, something like that. I'm okay with that, but I think I might be able to squeeze even a little more value out of it. And I'll do that by, instead of selling someone else a call at that current price of $391, I'm going to sell it to them for a price $20 higher.
Yep.
Or $10 higher. Because honestly, while I think it will go up, I don't think it'll go up that much in the next month. I think we're a little, maybe the thesis is, I think we're a little extended. We've had a pretty quick run. There's probably going to be some little pullback here. I think I can make some money on this if I sell it at 401, not 391, and have it expire in a week. And if it doesn't go past 401, great. I still own my SPY. I made a little money selling a call to, in this case maybe Adrian, and I just squeezed a little more value of a position I liked owning. I wasn't going to sell, and now I'm better off. So in this case, it's an income play as opposed to a speculative play.
Yes. That is exactly what it is. So what Eric has described is a covered call. He owns the stock. He has sold the option at 401 to expire next week, and he is expecting to just collect the income because he does not believe the stock will go above 401. His risk in this case would be the opportunity of what he could have earned if it does go through 401. At 401, he's required to sell it to someone else. So if it goes up $100, like we described, we use the currently it's at 391. So if it goes up to 401, he made $10 a share, and he got paid. I looked at the price right now. He got paid 15 cents a share. If you said a week from now at 401, you would have got 15 cents. So in that week, you would have made $10.15. But if it went up $100, you will not make a penny more than the $10.15, and you would have missed out. So he is taking a position, so to speak, because he's saying, I don't think it'll go up beyond this level, but his risk is capped because if it goes to the moon, he will not lose beyond what he could have earned over 401.
All right. So, Adrian, you said you had something the listeners should understand.
Yeah, of course.
Probably
Thanks,
value.
Eric. Appreciate that. I thought those are some very interesting points that you and Roshan both brought up. And on a side note, Roshan, you're on fire today with all the puns. I really like all the little jokes here and there. They've been really great. But I also want to introduce another important concept when it comes to options, and another important element when it comes to this is the role that volatility plays when it comes to options. When there is an increase in volatility, it can create extreme values, which can increase how much money you're paying or pocketing when it comes to premium for options. So I think that's also an important discussion we can have. And it could be the opposite, where there is a decrease in volatility. It can negatively impact the value of options. So volatility does play a big role when it comes to writing options or buying them, and I think that'd be an important discussion. What do you think, Roshan?
Yeah, definitely an important factor. As we were describing the option, the important features of an option, and I'm going to keep repeating them just because I want to make sure everyone understands it. The important features were: 1, when does it expire? That's the expiration date. 2 is the spot price. That's the price. 2 is the strike price. That's the strike price at which the option is in the money or out of the money. And remember, just because I said it by accident, the spot price is the current price, but it's not involved in the contract. It does affect the price of the contract, but it's not involved. So the 3 factors, again, I only named 2, so I'm going to start over because I messed it up. The strike price, at what price are you in the money with your option? The expiration date, when does it expire? And 3, the premium. How much are you paying for that contract? Or if you're a seller, how much are you getting for being the seller in the contract? What Adrian just talked about, volatility, the volatility will help determine the premium. The more volatility, the in this case we've been using the spiders, the SPY, that is an ETF of the S&P 500. The more the S&P 500 is bouncing around, the higher the premium will be. And the reason the premium is higher is because the likelihood of the stock going beyond the strike price goes up. So if you're a buyer and the market's been moving crazy and you're buying at something that's just $1 away, you're going to pay a lot more because the markets have been moving up and down a lot than you would if you were a buyer $1 away from the market and everything had been calm as far as the movements of the market itself. And I'm sorry, I keep saying the market because we're using SPY, the spiders. The same applies for an individual stock. If you're buying or selling an option on an individual stock and you're looking at a stock that is a slow and steady mover, you're not going to either pay much in a premium or get much in income in the premium. But if you're looking at a stock that's been flying around like crazy, you'll either have to pay more if you want to make a speculative bet, or if you want to collect the income, you'll get more income with that. So it's worth noting that especially if you're writing the option to collect income in this case, when you're getting the higher premium, it's because the likelihood of it going through your price is higher, right? That's the volatility factor. The volatility doesn't mean the market is just giving you more money. It means the likelihood of you being on the wrong side of that transaction is higher. So in the example we used earlier of the SPY going up $100 in a day, well, if the SPY has been slow and steady and moving at pennies at a time every day for the last year, the premium is going to be very little. But if the SPY has been jumping around $100 a day, then the premium will be higher because the likelihood of it going through your price is higher.
Yeah, that's a great point, Roshan. It really says that you really need to understand the market environment you're in when it comes to looking at options and the underlying asset, how much it moves, how much its price moves is an extremely important factor to consider, which I think is a great discussion to have and for our listeners to understand. Eric, do you want to touch a little bit on what Roshan said, or do you want to move up to a new topic?
Can I actually add one thing before we move
Roshan.
on that volatility and on the risk we've talked about? When Eric, you mentioned naked versus covered options, it's a totally different world when you're looking at naked options versus covered options, because just the risk factor is so much higher in one case versus the other. So when Adrian, you mentioned just now how things can get complicated and you've got to understand the environment. And Erik, at the beginning, you had said it sounds complicated and scary. Why should I listen? Yes, I'm adding on another complication, but by saying how important naked versus covered are and how that makes such a big difference, I just thought it was very important to note that you've got to understand your risk. And if you're getting into a naked option position, your risk is so high, right? Versus, and just this example, when we talked about it earlier, Adrian, if I paid you $85 for that call option, yes, my risk is only $85 in that example. But if I'm wrong, I lose 100% of what I put in, right? Whereas the S&P 500 is not going to lose 100% in a day, right? Barring my statement earlier of nothing's impossible, the world would be a terrible place if that were to happen for, not only us in the financial services business, but for the whole country. But you get my point. It is very, very possible that you lose 100% of what you put in an option if you bought a naked option, whether it's on the put or call side. It's very likely you lose everything. Whereas if you just bought a stock, it's very, very unlikely, and we're talking in a day now, but that you'll lose everything.
All right. So I would want to summarize this in the following way. We have potentially three different audiences. One are, and I'm going to use the analogy of automobiles and people looking for transportation. So we have one group of people who are auto mechanics. They need to understand the underlying mechanisms of a vehicle intimately because they're charged with maintaining and repairing those vehicles. The second audience we have are people who drive cars. They don't need to know how the engine works necessarily. They don't need to know how the braking and other systems work. They just need to know how to drive it correctly to the right destination without getting in an accident. And then the third group are people who hire either a chauffeur or hire an Uber driver to get them someplace so that they can look at their phone and just wind up, when they arrive at their destination safely, hop out and get to whatever's next. A lot of this conversation has been, I think, geared toward beginning mechanics and less to drivers, and certainly not to Uber riders. So I guess I would like to just summarize in terms of you drivers. I just want to say to you drivers, if we were to isolate your attention on two ways of getting from A to B that we've touched upon today, one of those would be to use covered calls. That is to say, if you own stock XYZ, your grandmother gave it to you, you for sentimental reasons cannot bear to part with it, and it's okay, it's not great, but it's not really there for an investment as much as it is because you feel like you have this duty to grandma, then you might hire someone. Don't do this. Wouldn't necessarily advise doing this yourself, to find a way to routinely and recurrently sell calls against your position in a way that allows you to get a little more value from it by generating some income.
And Erik, I just want to add on, I just want to change a word you used. You said you might want to use this. I would rephrase that to say you might want to research this. Right? Once again, this is just an introduction. I really think if this sounds like something that could work for you, look into it further. I would not tell you to go out and write a covered call based on this podcast alone.
Okay, fair enough. Yeah, I'm so duly noted. And then on the other end is that if you said, I want to protect the position that grandma gave me, and I'm not prepared to lose a lot of money because I kept this here, you might look into, there you go, Roshan, you might look into or research buying, not selling, buying this time those put options, meaning that if your stock, your beloved XYZ stock, fell dramatically because there was some terrible news that came out about it, or it was caught up in a big overall market decline, you, rather than feeling like you had to part with it, could use that use that put option that you purchased, which allows you to sell it at a much higher price potentially than it's currently trading at. And then, again, to preserve your love affair, you could go ahead and, after you've sold it at that super high price, you could just repurchase it now at the much lower price. You'll still own as many shares. You just didn't get your portfolio trashed, potentially, by that big decline in the stock that Grandma gave you. So there's a note to drivers. And if then you're more an Uber rider, then I would just say hire Roshan, and Roshan and Adrian can help you with doing this on autopilot for you.
Yeah, this is definitely a topic that I said at the beginning, I'll say it at the end, I can't caution you enough, because you can lose. I can't think of many other ways you can lose money, a lot of money, really fast than with options, right? So you've really got to be careful that you use these correctly. And I used to say I don't know many options traders that have been able to time things and just been great. I haven't found. I wish there was a quote, but there's a quote by one of these great investors that is the Hall of Fame of speculators has no members, right? Something like that. And this is just where if you're speculating on a stock, trying to bet based on nothing, but you think it'll go up, and you're just speculating, especially if it's on a day, right? You're not investing, you're speculating and trading. You can lose money doing that. If you do that with options, you can lose so much more money so quickly. So just be careful out there.
All right. Well, guys, we're at about time. Is there any final thought that either of you wants to offer?
No, Eric, I think I actually think
Okay.
your automobile analogy was a great way to wrap it up.
Okay. All right. So, listeners, thank you so much for sticking with us today. And thank you for listening to other episodes as well. I want to ask you, if you haven't done so already, using your favorite podcast app, whether that's Apple Podcasts, Spotify, Stitcher, you name it, please subscribe, and invite your friends to subscribe as well. That way you'll help spread the value of what we're creating here on a weekly basis. If you also need help in some way or have questions about anything that we've raised in the show, you can certainly go to the show notes, or you can reach out to us and you'll find our contact information in the show notes. We'd love to be able to answer your questions. In fact, if you do have questions that you'd like to have answered on the podcast, go ahead and forward us those questions as well. And just as Neil asked us to talk about options, if there's a topic that you'd like us to address as well, we'd be delighted to do that for you. So once again, thanks so much, and we look forward to speaking with you next week.